I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today we are answering a question: should I lock my interest rate?
Wow. Locking interest rates.
What do you think about that?
Yeah, I mean, just the sound of it, you kind of sound like you're in the cockpit, and someone's like, hey, are we going to lock in? But that's probably one of the most exciting, not always a great time, but one of the most exciting parts about a purchase or a refi is actually locking. Like, something really big happens when you lock. It's just not a button that you press. It's a big deal.
That's right. And it's not a button that you can undo. I mean, once you lock, the idea is that it's locked, right? The key is kind of thrown away. There's no going back.
I have a lot of borrowers that think that the bank controls the interest rates, and like, well, you know what? If we lock, can you just simply unlock the button, or is there anything that you can do about the rate? And we are really at the hands and mercy of the market. So that should make consumers feel good that there's a much larger machine out there that is actually producing these interest rates, and it's not just up to Sally or Bob. Controlling the rates. That's
right. So as the mortgage market is being traded, like the actual notes are being traded on the market in Wall Street, the banks, when they're actually locking your loans, what they're doing is they're making a commitment and they're hedging that lock, because as their interest rates go up and down, they're basically saying, okay, they take a basket of all their loans that they're doing that day and they hedge the market. They probably either buy an option or buy it, do some type of futures move on it. But the point is they're hedging to protect themselves.
Yeah, well, so I was going to say, and so what you're talking about is there's actually two parties. It's not just that there's you, the borrower, and some, big cloud or some, no-name piece of paper with a lock on it. You actually have another party out there saying, we are willing to lend the money to you at this rate. If you agree to do this, I will agree to do that. And so the lock is really a mutual acceptance between the parties. And I think that's very important, that the borrower is getting a benefit. But the only reason why there's a benefit there is because there's also an equal reaction benefit on the lender side. They're actually getting a rate that they know they're going to be able to receive for many, many, many years. So it should benefit both parties. Otherwise, no banks would lend and no borrowers would borrow.
That's right. So I think that, going through these slides, one of the things we're going to be, we were talking about what an interest rate lock is. We're explaining that now. One of the, we're going to go through the pros and cons real quick. I think that for the most part, everybody makes a much bigger deal out of locking in an interest rate. And I mean, what I mean is they make a much bigger deal of, they agonize over this question: should I lock or should I not? I mean, as though they can predict where the rates are going to go. Yes, there are some people who are very financially savvy, but I mean, we're in the business every day. We don't know where they're going to go tomorrow, next month. We can project, but if we were that good at it, we wouldn't even need to be in this business doing loans, right? We'd be trading Wall Street notes. Yeah, well, we would be on some island somewhere, and followers would be following our, I don't know what we'd be
hedge
fund managers or something.
Collecting coconuts or something. Okay, so how about this? And I just thought of this as we were putting this podcast together, and we just went through this. When's the last time you bought an airline ticket? If you go online and you start searching for airline tickets, what do? Hey, here's a round trip airfare for $339. And then, you go back, a day later or even an hour later, and it's like, oh, same flight now for $460. So it really is kind of interesting.
I think everybody's experienced that. That is just total BS, isn't it?
Yeah, it is. And I will tell you, and I do think that there's something going on in the airline industry, because every time you go on, it actually goes up. But the whole point is that when you have a ticket and you need to go someplace, is it worth waiting for it to go down? Whether you're dropping kids off for school and you have an upcoming deadline, or you have a funeral to go to, or a wedding to go to, or a reunion, the most important thing is to get that plane ticket. is to get that plane ticket and not agonize too much over the pricing if you see a ticket that you can afford. Because, yes, it could come down.
I like
you
that.
Could get, you get some type of super saver seat right by the bathroom. So, and then the other thing I just thought of is this. The time to think about interest rates is probably not at the time that you think you should. If you're very concerned about interest rates, you might look at it from a more macro perspective, from a quarter perspective, or from a yearly perspective. What are interest rates going to be in 2023? Should I buy or should I sell? By the time you buy a house, I mean, you're in the river. You're right there, and the rates may move a tiny bit, but they are not going to move that much. With that said, they could. So therein lies the reason why we've been having this podcast. But I do find, like what you said, people agonize over it. And really, if you just pull yourself out of it, you're already in the process of refining or purchasing. Move forward with it if the rate is close enough.
Yeah, and they're thinking of interest rates like they're day trading a stock. Yeah, what is it going to be tomorrow morning? What is it going to be tomorrow? And in the evening, I mean, do they go up yet? Do they go down yet? It's like, well, that you're day trading your rate, so it's just, it's not even worth it. Now, so here we go. I mean, there are cons. We're going to go over to let's just say the mortgage rate pros. Right now, it does give you security, knowing that it's done. You're locked in. You can just go on and if you're refinancing, you don't have to think about it anymore. If you're buying a house, you don't have to think about the rate. You just think about the house. Think about doing your due diligence on the purchase. And so one of the pros here is that security. If you like the rate you have, you just keep it, right? And now your lock will expire. There's a lock expiration on your rates, which your lender should get, and usually that is going to be a 30-day lock, a 45, and then up to 60 days. But typically it depends on when the home is going to be closing, if it's a purchase or if it's a refinance. The lender just wants to make sure that they don't want it to expire too soon. So
right, okay.
Give that peace of mind for that period of time.
Yeah. Okay. So again, when you're looking at the interest rate, it's almost a little bit too late at that moment because you're already in the moment of needing to buy or needing to refi. You could wait, but you're risking things. How about this? How about if you decide not to lock and to float, you run the risk of interest rates going up. Okay, you do have the potential gain of it coming down, but guess what? If it comes down a week later, why would it not go down 2 weeks later, or 2 months later, or 2 years later? So what I advise clients and what we do is we say, listen, we always typically say, unless we have a crystal ball, we're going to advise to lock. You don't have to. We don't get anything out of it, but we advise to lock. Because if the rate does go down in 6 months, 12 months, 18 months, we're going to chase that rate down. We would never advise any of our clients to say, hey, sit on the couch, let it float, and let's just pray together that it goes down. No, lock into that rate so that you have a guaranteed number that you can budget against. And as it goes down, we go down and get it. And it may go down 3 times. We don't control it, But anyway, so I think that makes a lot of sense. Lock in, peace of mind, and we can chase that rate down.
So one of the pros here, real quick, is that you don't have to worry about your monthly payment changing once it's locked in. That happened to a borrower of mine. He had it dead set where he wanted his payment. And he didn't want to lock. So what happened was, if you look at this third point here, this third pro, this bullet point here, it was a last-minute scramble. Rates had gone up a quarter, but he still wanted that payment to be that amount. So he had to pay a couple $1,000s. Now he had a large loan amount, but it can be quickly add up. It's about a $2,000 additional cost in the form of points to buy down that rate to get that payment. And that's because he didn't lock.
And you brought up a good point. You know what? Loan amounts have a big deal. You have a small loan amount. That's not nearly as big of a question as a large loan amount. You have a $500,000 loan amount or $600,000. It doesn't take much of an interest rate move in order for that payment to change.
The negatives, the cons of locking. So we've discussed already. Yeah, you could get lucky, and I say lucky because we really don't have the skill. I don't believe many people have the skill to know when rates are going to go down, but if you do, good for you. You probably don't need a mortgage. But anyway, if rates do go down, you can get a lower interest rate if you don't. And we call that floating. If you don't lock, a rate. You're actually floating the rate, and you could get a lower rate. So if you did lock, you're going to miss out on that lower rate. That's one of the cons.
The float downs, I think, are more gimmicky than anything else because you'd have to pay for them.
Yeah, there will be banks out there who will say, hey, we have a float down option. If rates go down lower, you can lock now here, and if rates go down lower, we'll give you that lower rate. But what they're insuring that deal. What they're doing is they're giving you a higher rate because they're hedging their bet too. They're giving you that insurance. They're giving you a higher rate to begin with, and they've built in that insurance premium so that if rates do go down, they're basically can give you something a lower rate. We do not like that structure of how the float down works, but we wanted to throw that out there and just let you know. Anyway, that is something you will hear.
Right, and now we do have an alternative. We don't like doing this, but if rates do move considerably for whatever reason, and through market conditions that we've seen with COVID over the past couple of years, the market has moved. We can sometimes renegotiate with the lender. There'd have to be enough movement in order for the lender to say, you know what, this person is going to end up moving their loan, so let's go ahead and keep it and let's renegotiate. And if they don't, renegotiate, we could think about moving, to a different bank. So we do offer.
So that's basically a con. I'm sorry, a pro. That's a positive about locking.
Yeah.
You actually do have the ability to renegotiate. If there's enough movement in the rates, you could renegotiate and get a lower rate, even if you were locked. But that is something, you don't want to go into the lock thinking that's what you're going to do.
Yeah.
But sometimes with those big movements, we can do that.
Yeah.
One of the negatives of a lock is that you do have an expiration. There's kind of a deadline. Is it a good thing, bad thing? I mean, really, it is a negative in a way because you do have to close. We want to close your loan by that deadline. So if you're trying to buy a house and we're cutting it too close, that expiration could be construed as kind of a negative thing. But that's why you always want to make sure your lender is locking you with an interest rate lock that expires at least a couple days beyond your home closing.
And if you're a borrower who's very excited to get into a home, they'd probably want the lock to expire before the closing so that they could get the house a little earlier because they think the lender's going to close a little bit quicker. That's just kind of a little joke. But yeah, that does it. It keeps the lender honest in that they've got this floor that they have to adhere to because if they go below it, that can be expensive for the lender. So,
yeah.
All right.
Okay, well, that wraps up the entire, what we're trying to do here, giving this podcast on the interest rate lock, whether you should do it or not, what the pros and cons are. We want to just make sure you know about this key point. Contact when people contact us, we want you to know, there's so many options that you have before you. You want to ask us, we'll be able to help build a strategy, a game plan around the market conditions, your close date, locking. But again, we'll be talking about your debt to income ratio and all the things that affect your mortgage. So be sure to reach out and we'll be able to help.
All right. Well, thanks a lot, folks.
Okay. If you like what we're doing here, be sure to subscribe and click the like button. Take care, everybody. Reach out with any questions.
All right. Bye-bye.
Bye-bye. Hey guys, thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com and be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 at 1618695, Equal Housing Lender.